Swayam Prabha. Digital India. Educated India.
Hello. In this session of security analysis and portfolio management, we are going to talk about the fundamental factors that affect the security prices in the market. And this particular session is known as economic analysis. Is a part of broad analysis called economic, industry and company analysis. Before we talk about how the stock's price will be there, how the valuation of a particular stock is going to be there, we should be aware of the things that is happening across the industries in that particular company belongs to, as well as the overall economy that the industry belongs to. So that has to be analyzed for a proper valuation of stock, forecasting of their financials and etc. So we move on to the fundamental analysis. This is a part of actually fundamental analysis. For fundamental analysis, we need to have the forecasted cash flow or forecasted profit of a particular company, and for that one has to look at the earnings and cash flow. In that case, that is known as fundamental analysis, and this fundamental analysis also known as we discussed earlier, it is EIC analysis, which comprises of economic analysis, industry analysis and company analysis. In this session we will be focusing on economic analysis to some extent, and this session will be continuing for the next part, where we will also continue the economic analysis. After that we will be discussing industry analysis and company analysis. Coming to the economic analysis, any fluctuation in security market that happens, it will be related to the expectation in the aggregate economy, and obviously the companies in fact the company's performance is tied to the economic performance, and the economic performance of a particular country is also tied to the broader international economic condition. And it is quite possible that in some cases the macroeconomic factors may influence the company's performance more than the company's its own performance relative to the particular other firm's performance in that particular sector. So for that matter, the economic analysis is of paramount importance. Coming to the next one, the part of the different things that we are going to cover in economic analysis. As we have all of us know, any domestic economy cannot be insulated from the factors affecting in the international economy as such, because we are living in an interdependency world, and so one nation's economic factor can affect another nation's economic factor. For instance, if a particular country is importing a lot from different other countries, and that exporting country's economic condition can affect the importing country's economic condition. So similarly, if a particular company is having a lot of revenue from the export market, particularly in the Indian countries, we look at the IT sector. So they are heavily dependent upon the income from the onshore or offshore activities for that matter, but the clients are spread across the world, and in fact their domestic sales may be much lesser than the international sales or international revenue from the international market. So in such case, anything happening in their clients economy is going to affect their performance, because the client's economy may drive that particular company or not for going for more production and all. In that case, the demand for the service of the IT sector in India can come down. In that case, this company's stock or the price of the stock is going to reflect that particular thing. So it is not possible to insulate the domestic economy from the international economic phenomena. So in fact, when you go for economic analysis, you have to also look at how it is there in the other country as such. So in a broader perspective, if somebody who is going to do an economic analysis, it has to look at how this particular economy is interdependent on other economy of the world. Then another thing that is there in the economic analysis, that one can have look at the political risk also can be of greater magnitude and can affect. So, even if the industry condition might be good in a particular economy, but the political condition, this democracy, this democratic setup, the legal setup and all those things can also affect the economic analysis. And so, that is sometimes the in the industry condition and the products of the particular market may be good, but because of the political condition the exporter may not like to export that particular country, and if your performance is based on the export revenue, in that case that is going to affect a lot as such. For instance, let us say something is happening in uh, Iraq and Iran for that matter, or suppose something is in Afghanistan and other parts of the country. If your products are sold in this particular segment and that particular country is having a is vulnerable to political risk more than any other country at this particular moment. So, in that case that is going to affect the economic condition there, and which is also going to affect the economic analysis that we are going to discuss as such. Similarly, the fluctuation in the exchange rates also can affect the economic analysis, because and in the company's performance, if there is again in the cost structure there is a lot of thing that is because of import, or in the revenue structure there is a lot of thing because of which is driven by the export as such. Any fluctuation in the currency rate, whether favorable or unfavorable, can affect adversely or favorably the company's performance. So, that also has to be looked into, and that cannot be kept aside for analysis of the particular company's performance, stock or economy for that matter. So, having discussed of the global economy, now we look at as we discussed that different countries can perform differently. This particular graph if one looks at, you can see there are two set of countries. One is the red one is the advanced economies, and the violet color one is the emerging and developing economies like India, China and Brazil and those countries. Developing advanced economies will typically comprise of US, Canada, G group 8 countries and all European Union countries. One can look at since 1970 this particular graph is there, and till 2014 is forecasted. So, one can see here till almost 1985 the emerging the advanced economies are doing bad than this one. So, this is a real GDP growth which is shown there. Emerging economies doing little better in the growth parameter, and you can see here, one can see here that there is almost the same performance in 1984-85, now it is almost same, that is the growth. Whereas, post 2000 one can see here there is a widespread gap, there is a very wide gap between the performance of advanced economy in terms of real GDP growth per annum between advanced economy and the emerging economies. And of course, one can see here there the movement in the things is more same. That means, some economies in advanced economies is doing well, then emerging also is doing well. If you have premised that the emerging economies revenue is somewhere, whenever there is a driver of from the other countries, that particular country's economy is going to affect the emerging economies countries companies for that matter. In that case, if that country is doing well, then emerging country economy can also do well. There is a possible link one can establish for that matter. Whatever we may say, it also says that there are opportunities of good growth in emerging and developing countries at this moment, and compared to the advanced countries. So, one can think of going for more of emerging countries economy stock, because the economy is doing well compared to other countries. Obviously, in that case the companies in that particular sector is supposed to be doing well, because economics performance is not on its own. The overall all the sectors of production, factors of production, how they do, that is going to drive the economic performance. So, how the agriculture is doing, how the industry is doing, how the service sector is doing, all those things combined together lead to the economic performance. So, one can look at opportunities in this way, that which particular country is doing well in economy, then we can think of as an analyst of as an investor analyst, we are searching for stocks to invest or the financial instruments to invest. One can look at first which economy is doing well, and accordingly we can go for that. Particularly those mutual funds or investment funds were allowed to invest in other countries. In that case, they will, for these things is going to be paramount importance as such. and one can see here we are expecting that 2013 14 also the emerging country is going to be doing better. In fact, there is a possibility that 2013 to 14 there is going to be a decline, the lower growth rate compared to the previous years, whereas the in emerging countries that fall in the growth rate is going to happen in case of advanced economies, whereas there will be almost same or increased the growth rate in case of emerging economies. So, that is an indicator that which country can go, and among these group of advanced countries, a group of emerging countries, for instance, in emerging countries we can see here that China is leading them, and it is almost having a double digit growth for a several period of time, and followed by India, which is also showing 7 to 8 or 9% growth in the recent past. So, somebody who is like to invest in the different economies for that matter in the emerging economies, he or she is likely to give importance maybe Chinese company stock, then Indian company stock, like that. It is not that only the particular emerging countries are doing well, means all the countries are doing well. One country may be doing well, one country doing well as such. So, but anyway, one has to look at those economic performance before we proceed. Proceeds to the micro sector or micro companies for that matter. Micro company is a single company they choose, they should also look at how the economy is doing. And coming to the next one, one can see here one of the this graph we have called index price earning ratio. This is as we know, the price earning ratio is nothing but market price divided by earnings per share. So, combinedly this particular Sensex or Nifty in Indian context have been taken, divided by their market capitalization divided by the combined earnings of this particular group of stocks in that Sensex, like 30 stocks, or in Nifty you have 50 stocks. So, there is a combined PE ratio of this particular Sensex or Nifty. One can see here that index PE in India has was between 15 and 20, and in 2003-4 it crossed 20, then it has again come down to 2004, 5 and 5, 6. We can see here there is a fall, and 5, 6 it has again gone up, like that. So, if you look at the overall trend here, that means the index PE has hovered between something around 13 to 22, 23. So, that is the way the index is performing. That means if the company's share is let us say 5 rupees, and let us say this overall index P is going to happen, let us say between 12 to 23, that means 12 into 5 could be the lower price, and 23 into 5 could be the higher price for that particular stock. If we assume that the P of this particular company is going to be the same as P of the index, that broad index as such. Actually, this index PE is a function of the company's performance. The company is doing well, then index will be doing well, and the earnings and the PE is going to be affected by the company's earnings as well as the price as such. And in fact, the earnings per share of a particular company can give an indicator how the stock is going to happen in subsequent time as such. So, the P are expecting the good earnings per share in the subsequent time period, there is a forecast earnings per share is going to be better. In that case, the company's share may move up because there is expected earnings is going to be better as such. So, if the company's earnings per share is going to be up compared to other sector, then price what you are going to pay for today is going to be higher than any other company as such. So, this is an indicator of how this company is going to, this sector is going to be there, how it is linked to the earnings per share of the companies as such. So, moving on to the next one, that you talk about the domestic macroeconomy, and in that macroeconomic analysis. So, what happens, one has to look at how this particular macroeconomic performance is going to be better, so that one can look for better opportunities, and as an analyst we have to forecast the economy better than any other analyst has. So, there is a, because the information about the macroeconomic factors are available to all analysts. Now, it is the ability to the analyst, one particular analyst, to how well he can forecast by applying certain quantitative techniques or econometric methods or time series analysis, whatever techniques there could be there. could apply and forecast how this particular company or for the economy is going to do in the future, and accordingly if the company economy not going to do well, then investor may be suggested, analyst may suggest the investor that to divest the stocks they have invested in that particular economy and move to those economy where there is a possibility of higher growth as such. So, that forecasting is the key thing in as per the analyst is concerned, and the forecasting has to be better than the other competitors as far as the analyst is concerned. Coming to the different factors of macroeconomy one has to look at. One has to in that case we are going to discuss in this case different factors like domestic product, interest rate, inflation, all those things are going to discuss one by one. And one of the major parameter of the economy and how the economy is ranked for that matter is the gross domestic product, and this measures the economy's total production of goods and services. And of course, the GDP of a particular country is like aggregate of the economic performance in those country, and GDP comprises of contribution from different factors production. It will comprise of agriculture, it will comprise of manufacturing sector, industrial sector, it will comprise of services sector, financial sector and all. And you will have different countries which have got GDP more contributed by services sector than manufacturing sector. We can see in Indian context that over the last few years or in the 1 or 2 decades, we can see that the services sector contribution is growing much higher than any other sector like manufacturing or agriculture sector in the total. Though the individual sector like agriculture, manufacturing might be increasing on overall trend, the total size of the contribution for that matter, but the proportion of the services sector is now is increasing. It is higher than the other sector, we can see that. And so, if the growth is there in the GDP, so it reflects that there is an opportunity for investing in a particular stock. So, GDP growth is a broad indicator of how it is. If the GDP growth is, let us say in one country it is 8%, another country is 4%. If everything is same otherwise, then in that case this country is going to be attracting more investment than the other country as such. So, GDP growth is a broad indicator of the economy, and every analyst, every economist is always look at that particular factor like GDP and its growth for analyzing the economy and for the investment purposes. And the GDP growth is also affected by the industrial growth. Industrial growth means how this particular manufacturing sector is doing, because when you talk about the stock market is driven by the corporate performance, and when you say corporate performance, the corporate performance is nothing but the how well these particular companies are doing, they are producing and producing goods and providing services, and these goods or service that has been provided by them is obviously mostly that is there you can manufacturing sector. So, different industrial sectors, how the IT sector is doing, how the power sector is doing, how the other manufacturing, core sector, infrastructure sector, steel sector, all those things are how they are doing overall, because those growth in that particular sector is going to drive the economy as such. Besides that, obviously, we also have the agriculture, and agriculture is also affected by a leading variable in case of at least Indian context, because as monsoon, and because the irrigated land percentage is lower than the non-irrigated land in Indian context. So, agriculture, how the agriculture is going to do, it will depend upon the how well the monsoon is going to be there. So, if there is a forecast of good monsoon in a particular at least in Indian context, then we can expect there is a agricultural production is going to be better as such, and such companies which are dependent on agriculture for their input, and that is definitely going to affect the company's performance. The agriculture is going to do well. For instance, if the sugarcane realization is going to better because of good monsoon or whatever for that matter, good facilities for that matter, definitely the sugar industry, sugar companies is going to be affected by that. There could be a lead and lag there, that yes, the agriculture is doing better, and the industry that derive the inputs from this agriculture sector will be doing better maybe subsequent time period. There could be a lead and lag, but the agriculture sector is going to drive also the certain company sectors performance. So, moreover, if the agriculture sector is doing well and there is a lot of production in, let us say, the essential items for that matter, and if that is going to do well, then inflation is going to be lower, and inflation is going to lower can also lead to a better consumer happiness and all those things, and the inflation is going to be lower also. That indicates that the companies the investors can invest in that particular sector where inflation is going to be lower, because lower inflation is something which the economy always like to achieve, and the policy makers always focus that inflation should be very high, it should be moderate enough, and if that is affected by the agricultural sector substantially, which is the case as such, and that is going to be the better as. So, agricultural sector is going to affect in a chain reaction that does well, this manufacturing sector can, certain sectors can do well, it also affects the inflation level in the country, and several other factors are affected. So, if the agriculture is doing well, driven by a good monsoon, is also going to be good indicator for the economy to invest in that country as such. Next, that we can see here graph here in Indian context, this graph shows the GDP at market price, that is these bars, and from 1999 2000 to 2008 2009 the GDP is around 5,25,000 crore for India as per 2008-9 is concerned. There is a steady growth, one can see growth here, and there is a this is also given provided by another graph, it is there, which is there the BSE Sensex, the Sensex value which was around 5,000 something, 5,000 plus, has declined in some period of time, then it has slowly and increased. In fact, the increase much higher compared to the growth in GDP, and there is a fall in the Sensex which 2008-9, which was driven by the likelihood recession, its effect on the Indian economy, and the share prices have fallen from 2007-8 peak to 2008-9, and it has now increased. If you can forecast the, if you take the Sensex values from 2008-9 to 2009-10, we can see there is a Sensex has actually increased in this time period. So, this is an indication how one can find out whether the GDP growth is happening before the Sensex has happened, or Sensex is leading, or the GDP is increased. So, if that is the case, if let us say it is proved that which also could be possibly true, that the say Sensex, which is the barometer of the particular market, let us say in Indian stock market, if it is going to do well, because the economy is going to do well. So, Sensex can be the leading indicator of what is economy. So, or somebody says the GDP is going to be better, and appreciating that the share price of the particular markets and stocks can also be higher, and that will reflect in higher Sensex. So, one can see here what is the relationship between the broad index factor, the market factor, the capital market, and the GDP of a particular country. Then moving on to the next factors that which affect the domestic macroeconomy, which should be analyzed in case of economic analysis. The next thing that we have is employment and capital utilization. Employment, for that matter, employment is for the labor force, and if for any reason the employment also can be discussed another way called unemployment rate. The unemployment rate is going to be higher, and that shows that there is no demand for the production in the country. That means, it could be something like this, that since there is no likelihood demand for the particular products in the particular economy, so the manufacturing facilities and all this will be remaining idle, and the labor force will also be idle, and there will be an unemployment for that matter. So, the unemployment in a particular country, it is high, obviously that is not going to be a good sign for any analyst to go to the particular market. Only this employment condition moves, then if the employment rate improves or unemployment rate declines, that can be indication that yes, this companies, this particular sector, this particular economy is going to do well in better. There is likelihood that there will be demand for the production services in the economy, and that is why there is a better utilization of the labor or employment facilities. This also, employment is one of the factor of production, labor is one of the factor of production, whereas the other factor of productions are there. We have is the capital capacity utilization of the capital goods as such. So, if there is a machine a particular company, if the capacity utilization is better, in that case obviously why the capacity is better, because the production is improving, production is higher now, and relative to the previous year's production, and production is higher because the likely demand is going to be higher and consumption is going to be higher, that is why production is higher. So, the increase in the employment rate or decrease in unemployment rate, increase in capacity utilization can indicate that this particular economy or this particular stock or this particular industry is going to do well in better. So, that is one of the things as an analyst one can have a look at. Next thing that you have is the price level and inflation. Any economy which is affected more very high inflation, okay, overheated economy where the inflation is very high, those economies are not advisable to invest in as such. So, because inflation is something which is not usually anywhere liked by any, because this indicates this price rise in the price is going to there. Of course, one can expect the economy to grow, at the same time inflation to be there to be moderate, because inflation reflects the price rise. Obviously, we cannot expect that the price of a particular product has to remain constant over a period of time, because there is always a greater demand from the labor for this employment, emoluments, salary, wages and all those things, that is going to be higher. In that case, the factor production cost that we are going to pay for that is also going to be higher, and for that matter the inflation can also be there. But that is one of the things which can be indicating how the economy is going to do, and we will be discussing more about the statistics of these particular factors like price level, inflation in the second part of this economic analysis. Next thing that we have here is the interest rates. And what happens in interest rate? The interest rate is something the overall the borrowing that is taking place by the companies or by the particular authorities, government authorities which borrow to take care of their deficit or whatever the requirement they have. And if the interest rate is going to be higher, certainly for certain sector it may not be good assets, and moreover for valuing the future or bringing down the future economic performance of a particular stock like cash flow or something like that, if you have to bring it down to today, one has to discount it by a particular rate of factor. Typically, what we have when we discussed in the earlier session or we will be discussing subsequent sessions, we see that any value today is nothing but summation of, let us say, if it is based on the cash flow. So, this T is the time and the summation of this thing that we have in the over a period of time, summation of this cash flow, and this I is the discounting factor to discount the future value and bring it to present value, and the discounting factor depends upon the overall interest rate in the economy as such. So, the interest rate is going to be higher, the discounting rate is going to be higher. In that case, the value of the particular stock which is dependent of the future performance, like let us say for example is the cash flow, in that case this value is going to be lower as such. So, high interest rate is something which can affect the value of the stock to be lower as such. And another thing that you have certain things like there are certain industries in the sector in the economy like automobile, we have consumer durables, housing for that matter. These things are driven more by the how easily the loans are available, how is borrowings available, and how is the interest rate as well, how good is the interest rate. The interest rate is lower, the demand for the products in this sector is going to be higher, because the consumers can borrow at a lower interest rate and buy these particular items. So, these sectors are going to do well, like let us say passenger car segment for that matter. The passenger car segment is going to do well when the interest on the passenger car loan is going to be lower, then obviously demand for that, because people have easy access to credit for this particular buying this particular asset. Then we some other items like consumer durables also, then you have housing which are also affected by the interest rate, they are sensitive. High interest rate will reduce the demand for the particular sector products as such. Then we have got another thing that is called the budget deficit. Deficit is something which is because government has certain expenditure requirement, but the revenue for that particular thing may not be sufficient to that, and to take care of the expenditure requirement, it could be a capital expenditure requirement or revenue expenditure requirement. and which is now showing which is not enough taken care by the revenue, then it will be whether it is a capital revenue from the recurring nature or the regular revenue like tax or any other revenue for the sale of assets by sale of stocks of the government sector like disinvestment, all those things, capital receipts and everything. If that is not sufficient to take care of expenditure, there is a deficit that will arise, and the deficit is actually can be financed by the borrowing by the particular country. Like for instance, Government of India will borrow from the market through Reserve Bank of India, and by issuing short term instrument like treasury bill or long term instrument like government securities, dated securities can be there, and the government is going to have more deficit and is also going to borrow more. That is going to set the trend for interest, and obviously the demand for money is more, interest is going to be higher if this money supply is not better and there is no much money available as such. In that case, there is interest is going to be higher. Another thing is that the government keeps on borrowing more and interest rate can be affected by that. Second thing is that it will also crowd out the corporate sector, which will also like to borrow. Government being a big player, if they borrow more, the corporate sector may not have that much resources left in the market to borrow as such. So, that is going to drive the interest rate as well as the ability of the private sector to borrow. They may have a better loan servicing capacity, but the fact is that the most of the borrowing has been done by the government, lot of money may not be available. So, what will happen in that case? There will be demand, if there is a company which is requiring finances and it was thinking of borrowing and the borrowing is not available, the company will eventually forced to go for stock equity, issue of equity shares. Before that also company can think of going for external commercial borrowing. So, anything that is happening can have a chain reaction. The government borrows more, corporate sector may not be able to borrow, or corporate sector borrowing can be driven by the interest rate that the government is borrowing at. Typically, corporate sector borrowing rate is going to be higher than the government's borrowing rate, and the corporate is not having enough funds to borrow in the market. The corporate may go for alternate source of finance, maybe in domestic equity issue, or maybe going for a bonds or debenture issued in the other country for that matter. So, that is going to be affected, and other countries in interest rate, the currency rate between that countries and our country, that is also going to affect now the company's performance. So, next thing that we have is the sentiment of the particular economy and the consumer sentiment and the producer sentiment. What happens? There are if certain researchers, certain agencies which make a survey of the consumers in a particular sector, and they find out how do they feel about it buying the things. If the consumers are feeling happy, the consumers happiness is much better. Consumers feeling happy means they are going to purchase more, and they are going to purchase more, then anticipating the good purchases, good demand from them, the companies can also produce better as such. So, in that case, if the consumers are feeling better, it is also a good thing for that matter. And similarly, producers optimism is there, the producers feel happy, because when the producers feel happy, when they feel that their order book has increased. Let us say one particular company is in a industrial goods sector, or it is in commercial vehicle sector, or is in power turbine production sector, like we have BHEL is one company, or L&T we have a company, or ABB India, that is a company which you have. They are all heavy industry sector, and they are driven there. One of the major product segment is selling of their power turbines, transformers, or all those things. And there is a gestation period between the products demand when we are going to use a power turbine or the transformer, heavy transformer for that matter, and when it can be given as. So, if you require a turbine after 2 years, possibly I have to place the order today. So, in that case what happens, the order book of these particular companies, which say that how many orders are there to be executed by this company over a period of time, can say how this particular sector is going to do as such. And if the order book size is better in this particular sector, this producer is obviously going to feel happy about that. Similarly, if the input supplies are in good condition, that supply that the raw material they are going to produce for that is also good condition, there is assured supply, and that is also there is no uncertainty there, and those input prices are also better than the earlier prices. So, all those things can lead to a producer's optimism that yes, they are going to do better, they are going to sell better, as well as they are going to produce them at a better cost, so that there will be pricing is going to be better, and the possibly benefits can be also given to the customer. So, if by making a survey, there are certain agencies who do survey for this consumers happiness index is there, how the producers confidence index is there, how they feel, how is the feeling in them, that if they are going to feel well, then obviously that particular economy is going to be doing better in future. So, better such indices is an attractive proposition for the investor to invest in those sector or those particular economy for that matter. If the people are pessimist that the company is not, the sector is not going to do better, obviously in that case there is a fact indication that if you have invested, possibly you have to withdraw from that particular market or for that particular industry. Going forward, we have got other thing that you have here to analyze in the economy, how the particular shocks that happen, demand shock or supply shock. So, when we say demand shock, that is that event that affects the demand for goods and services in the economy. And demand, for example, what you have here, reduction in the tax rate. If the tax rate in a particular country is reduced, let us say the income tax rate for that matter, the individuals, obviously there will be a better consumer surplus to buy more, and it can lead to a demand for goods and services. Or let us say there is an reduction in the indirect taxes like excise, value added taxes. If those are things are going to be there, like we saw when the last fiscal we had, last 2 years we saw that the government has reduced certain rates, and that has to stimulate the economy, so that it can insulate to some extent the effect of recession that is happening elsewhere. So, we could see that Indian economy did not suffer as any other developing developed economy for that matter. Though this growth in GDP and everything is lower than the previous years, but still we could see that to lot extent, to very large extent, the Indian economy could be insulated from that, because the government could take the right steps as such, and that could be done. See, one can see that 1990s we had the 97, 98 we had the Southeast Asian financial crisis. So, there the companies suffered a lot, but Indian economy was not suffering like that, though the Indian economy is still in liberalization, the initial stage of liberalization that was happening then. Similarly, now we can see that Indian economy has done better than other economy because of the government's intervention. Government intervention can be there in case of reduction in the tax rate, indirect tax or direct tax. The government has spent more money, government can go for more spending in welfare sector, which will like we have got the rural employment guarantee schemes, where the minimum wages are given by the for a particular work, the beneficiary is going to get the minimum wages for a particular number days in a particular year. So, that enhances their purchasing power, and the purchasing power enhances their ability to buy the goods will be better, and if that is better, the industry is going to do better. So, demand for the particular sector's products is also going to be better. So, these are the things which you have got demand shocks, and the demand shocks usually are characterized by the aggregate output moving in the same direction as the interest rates. So, the interest rate is going to be better, then the borrowing capacity of the particular company is going to be better, and the borrowing is better, then the products, the capital goods can be purchased in a better manner, it can be invested then, and the industry will do better. And like that, if there is of course, ultimately it can lead to certain times it may lead to inflation, and then there can be a decline in the economy also. So, demand shocks may do the things better for the economy, but can also lead to a subsequently that yes, the demand for the particular sector and all these things may decline because of there is inflation, which is like a chain reaction can also happen. And coming to the next thing, that you have the supply shocks. Supply shock is that shock that what happens, the production capacity and the cost are adversely affected. That means costs are going to be higher and the production capacity is going to be lower. That could be the influencing there. So, let us say there is a natural calamity, drought, famine, flood and all those things, that is going to have an adverse effect on the production and also on the cost as such. Then the overall wage rates in the economy is affected adversely, that also can lead to lower production, lower output, lower demand and all those things. And another important thing that we have here is the price of the imported oil. If the economy is heavily dependent on the oil, and the oil is not produced or explored from the domestic sector, rather it is imported from the foreign for the other economies, like India depends to the majority extent for the oil demand from the import, and in that case, that is the price is going to be higher, that is going to have a cascading effect on the all this performance of the all this sector. For instance, if the oil price goes up, the transport sector is going to charge more, they are going to be affected, and the transport sector is going to charge higher, then the transportation cost of a particular product is going to be higher, and that is ultimately going to be passed to the consumers, and in that case the price is going to be higher. In that case, the demand for the particular product is going to be lower, and it will be affecting all the products and services, whether directly or indirectly for that matter. And usually it is seen that if the inflation is going to be higher, interest rate is going to be higher, the supply is going to be lower. Earlier in the demand shock, we saw that inflation is going to be higher, could be an indication that the economy is going to be better, interest rate is going to be lower, inflation is going to be lower, the economy is going to be doing better as such. So, now there can be some of the industries which may go as the demand and supply condition is moving, there may be some industry which may be just be contrarian as such. So, there may be a condition that overall the economy is doing not better, but this particular sector may be doing better. This industry or the stock that is called contrarian stocks as so that is also there. So, analysts have to find out which are industries which are going to be doing better in demand and supply condition. For instance, if the interest rates are going to be lower, so it is an indication for the analyst to go for those companies like we discussed in the previous slides, that housing sector, automobile sector, passenger car sector, all those industries are going to be doing better as such. It is better that one can invest in those particular sectors. Moving further, we have got the other thing that you have here is the government policy intervention that happens. So, government's policy is typically on the either on the demand side policy or on the supply side policy. When you say demand side policy, it is going to stimulate the demand for the goods and services. Like you have a fiscal policy, as we discussed earlier also, the tax rate is a part of the fiscal policy of the government. The tax rate can be moderated, can be increased or can be decreased, and by decreasing the tax rate, the demand for the particular products are going to be, demand condition is going to improve. So, government may intervene with a particular fiscal policy depending on the condition of the economy, and making going for a proper balance in the economy for that matter. Then in the monetary policy, which talks about which is obviously going to affect the overall interest rate in the economy for that matter, and the monetary policies, there are instruments in the economy that is given by the particular regulator like Reserve Bank of India in Indian context. The Reserve Bank of India periodically intervenes in the market by certain instruments called cash reserve ratio, then one has called something called statutory liquidity ratio, then we have got certain rates like repo rates, then you have some instruments like discounting rates. So, what happens as per the cash reserve ratio, what happens in the cash reserve ratio, the banks are supposed to be required to maintain a minimum cash of certain like 5 to 7, there is certain cash reserve ratio that is given by the particular regulator in the particular country. They have going to maintain that particular cash with the Reserve Bank or the designated banks for that matter, or with themselves they are going to keep the cash for liquidity things. So, for instance, if the cash reserve ratio is going to be higher, that means the ability to lend money by the banker is going to be higher. So, the Reserve Bank of India feels that money supply is higher in the economy, and the money supply is higher also going to affect the inflation is going to be higher. If that is the feeling that regulators and the government feel as such, the government through Reserve Bank of India or Reserve Bank of India on its own can intervene in the market by increasing the cash ratio, so that the supply for money supply of the particular economy is reduced, and that can possibly lead to certain reduction in the inflation and all. And similarly, we have got something called statutory liquidity ratio. So, statutory liquidity ratio is something which is the mandate of the Reserve Bank of India to invest in a particular type of securities which are liquid securities. So, that maintains the liquidity particular bank, so that the because when the investors have deposited something in the bank, they can withdraw at any point of time. Of course, there may be certain terms and conditions for that matter, but there is demand for the money is going to be there from the bank itself. So, in that case, to maintain that, it will be this particular securities can be realized into cash, obviously without decreasing the SLR for that matter. Another thing, by having indicated a particular SLR which is also on those designated securities like government securities. So, there is an incentive for there is a requirement that the banks will be investing those securities, and those securities will be obviously issued by mostly by the government of India. So, government of borrowing is also facilitated there, and there is also market for the government's borrowing schemes for that matter. Then next thing that we have is the repo rates. Repo rate is something that the RBI indicates, and repo rate is something when a particular investor can invest sell the security that he or the investor hold, the institution hold, and there is a condition that this particular instrument is going to purchased back by the investor in future period. So, that is, and that rate which is there in this is called repo rate. There is a repurchase rate, okay, and the repurchase rate is indicated by the Reserve Bank of India, and in fact, this repo rate is an indicator how the interest rate going to be there. So, repo rate, decline in repo rate by the government of by the Reserve Bank of India indicates that possible the interest rate is higher, or there is a requirement that interest rate should be lower. As the interest is lower, as you have discussed, certain sectors and overall all these sectors are affected directly or indirectly by the movement in the interest rate, and if the interest is lower, possibly the demand for the particular product in a particular sector which is affected by the interest rate more, and that is going to be higher for that matter. Similarly, we have got discounting rate is also another indicator of interest rates. Discounting rates is something where the commercial banks can discount their bills of exchange or rediscount the bills of exchange with the Reserve Bank of India and get the finances. So, these are all indicator rates as such, and which is indicator that how the interest rate is likely or should be moving in future in the country as such. Then coming to the supply side policies is that the government has to create an environment or good incentive, so that the for the workers, and so that there is a good utilization of factors of production. So, owners of capital are likely to use their capital better, they are going to use their capital products better, they are going to have better capital utilization, workers are going to have a better wages, or at least their unemployment rate is going to be lower. So, the government creates such incentives which will facilitate better supply of the particular goods and products and services. This is the government can intervene as such, and government can look at providing incentives, subsidies, tax concessions, all those things can be there as a supply side booster from the economy, which we have seen in Indian context that has happened in the last 2-3 years to withhold, to reduce the effect of recession that is happening in elsewhere as such. Moving on further, there are certain economic forecasting techniques, and what happens in economic forecasting techniques? We have got certain things like cyclical indicator approach, then we have got diffusion indices, then we have got something called econometric models. These are the three ways one can forecast how the economy is going to behave in future. And cyclical indicator approach broadly talks about that how cyclical is that, and there are certain things which is going to happen today which may lead something to happening tomorrow. And the cyclical indicators can be of different types, like we have got leading indicator, then you have got coincidence indicators, then you have got lagging indicators. When you say leading indicators, these are the indicators which will have certain peaks or troops, and before the corresponding peaks and troops in the aggregate economic activity. That means, if there is a upward movement, let us say we have a cycle that there is a peak going to happen and there is a trough, like that. These are the typically business cycle. We have got a peak, then the falls, then you have this is boom period, then you have a recession here. Now, what happens if it is a leading indicator, that means that it is going to if this is going to be a leading indicator, that means if there is a peak here and this is going to happen before the peak happens in the other indicator, if that is affecting something like the economy for that matter. For instance, if the average weekly hours and manufacturing is one of the these are certain factors which an organization called conference board in western market. In US you have a conference board which has given certain factors of leading indicators and overall cyclical indicators. So, as per that, for instance, if you have got something called average weekly hours in manufacturing, how much hours are going to spend as such, and average weekly initial claims of unemployment insurance, manufacturers new orders, consumer goods and markets, then you have got vendor performance, slower delivery decision index, then you have got for manufacture new orders for non-defense capital goods, then you have got building permits, then you have got new private housing units. What happens if the, for instance, if the order book is better now, that means economy as a particular economy is going to do better in little later. So, this is a leading indicator that is if the manufacturing labor hours is going to better, obviously in that case this is going to lead to indicate that yes, there is more production, more labors are utilized and that particular sector is going to doing better as such. So, these are the leading indicators: money supply, interest rate spread between government securities and the treasury bonds, then index of consumer expectation, the consumer is expecting better now, that means the economy is going to better tomorrow as such. So, they are the indicators which lead that yes, this something better is going to happen tomorrow, or it can be something, if something bad is happening in this, that means something bad is going to happen in the economy tomorrow. There is a fall in the particular indicator, that means the overall indicator there is going to fall subsequently as such. Then we have got the next type of indicator is called coincidence indicator. So, coincidence indicator is something, the peaks in this indicator is accompanied by the peaks in the broad sector or broad economy as such. So, this is a peak in this indicator, this is the indicator, this is the economic performance, then there is a peak here, there is also a peak here. So, there is a coincidence, they are moving parallel as such. For instance, for example, you have got employees on non-agricultural payrolls, if they are going to get better salaries, so there is going to be immediate demand for the products now then itself. If the personal income is better, the consumer surplus is better, they are going to, then it is going to lead to a better things in the economy then only. Like that, you have an index of industrial production, when it is derived out of the production that has happened, and better production means better GDP and all, that is immediately that is happening, because production today cannot be affecting GDP tomorrow as such. Okay. So, because production itself is combined from different sectors and GDP is found out. Then we have got certain indicators called lagging indicator. In this case, we are talking about that yes, if there is a decrease there is a movement, upward movement in the indicator like this, let us say the economy will be moving in some other way, like there will be an could be a up, this is the economy, this is the indicator and this is the economic performance of a particular country. Then if there is a peak here which will be leading to a peak in this economy in the future as such, the indicator is a fall which is indicating that there is going to fall in the economic performance as such. So, that is explaining the peaks and troughs after those of aggregate economy has happened. So, the economy has done worse, then this particular indicator is going to be worse as such. And so, like unemployment, if the economy has not done well, so unemployment is going to be O's there, then inventory to sales ratio, then manufacturing and trade, change in labor cost per unit of output, manufacturing, average prime rate charged by the banks, commercial industrial loans, are all these things. In fact, this particular agency has got a certain weightages for different indicators, which then the composite index is found out. It is not that all this fact that we have talked about is they are having equal weightages. So, in this session up to this we have talked about the indicators, we have talked about the major economic factors that affect the economy as such, and how can the analyst look at how the particular economy is going to do in future based on different sectors in the economy. In the subsequent session, we are going to talk about more other factors of economic indicators. We are also going to exhibit certain charts, graphs which can talk about those indicators that we have discussed in this session. Thank you.